गुड इवनिंग एंड वेलकम बैक टू पैसा बोलता है। पैसा बोलता है में आपका फिर से स्वागत है। टुडे आई वांट टू टॉक अबाउट द स्टेट ऑफ द इंडियन बैंकिंग इंडस्ट्री। बैंक stocks have been under pressure for some time and have started to recover, and it recovered on the hope that the Reserve Bank would not increase interest rates. As expected, much to the relief of the banks, the Reserve Bank of India decided not to increase interest rates. This has led to a rally in bank stocks and will continue to lead to a rally in bank stocks. What is the relationship between interest rates and banking stocks? When RBI increases interest rates, what happens is both the interest rates go up. The rate at which people borrow money also goes up, and the rate at which money is borrowed by the bank also goes up. What do I mean when I say money borrowed by a bank? A bank does not lend only the money it has as equity and reserves and surplus, which is the equity capital of any company. The bank leverages this several times by using certain bond instruments and also using deposits. Deposits are of three types. One, you have current accounts in which the bank pays no interest. Then you have savings bank account where the bank pays interest. Third, you have fixed deposits where the bank pays an amount when you park the money in the bank for a fixed period of time. And fourth, finally, bank has term deposits or big deposits. Normally, banks prefer CASA, that is current account and savings account, to be very high. This is because savings rate and current account rates are normally much lower than FD and term deposit rates or bond rates. In fact, for current account, the rate is zero. If a bank has high CASA, and it means that the bank is having access to cheap funds. Big banks like State Bank of India, HDFC Bank, and ICICI Bank thrive on very high CASA. And most banks chase to open bank accounts because more bank accounts mean more CASA deposits. This is the way the banking industry performs. When the Reserve Bank of India increases interest rates, what happens is first the borrower suffers because interest rates on loan go up. Next, the depositors, both fixed and term depositors, ask for more interest or more compensation. If not, they will shift from one bank to another bank. Therefore, banks are forced to increase fixed deposit rates and term rates. The smaller banks are under pressure to increase their savings bank rates also. This means with the rising of fixed deposit rates and the lending rates, normally net interest rate should remain same. That is called as NIM or net interest margin. But normally what happens is when there is an extended rate hiking cycle, the fixed deposits and the savings bank rates go up faster than the lending rates. This leads to contracting NIM, and when NIM contracts, the margin of the bank takes a hit. This is why when the interest rates go up, banking stocks correct and correct big time. There is another problem. The compact between a bank and the government is that we will allow you to raise money, especially unsecured money, if you buy our securities. Basically, government borrows money from the market, and these securities are bought by banks and insurance companies primarily, and then even mutual funds. So, banks are buyers of government securities, which are considered safe assets. Now, there are two combinations. One is bank buys government bonds for the statutory SLR or the statutory liquidity ratio, and they buy more and above that so that in times of emergency they can park it with the Reserve Bank and raise more capital. Now, these bonds are called as held to maturity characteristics. That is, you can declare that these bonds are being held for maturity. What happens is when the Reserve Bank increases interest rates, government yields spike. When government yields spike, existing bonds correct in price to adjust with the yield. That means banks that hold bonds up to held for maturity have to write down the value of bonds in their portfolio. And this is called as a mark to market loss. So there is a double whammy. The double whammy being your net interest margin contracts, and at the same time your mark to market losses also increase. The mark to market losses of bonds are primarily in the public sector because public sector banks hold much more government securities because they are owned by the government. So, in these troubled times, it is possible for you to fish for proper stocks. Now, there are three categories of banking stocks in India. There is the public sector bank, there is the old private sector bank, there is old aggressive private sector bank, and then there are small banks, and you can pick and choose anything that you want. Normally, as a principle, I avoid public sector banks completely. Among the old private sector banks, ICICI, Kotak, and HDFC Bank are the largest, but these are very pricey. Money, when the market deeply corrects, you are given an opportunity to buy into these stocks. But at that time, there's an overall correction, and you don't know how much you can buy. But there are other smaller private sector bank stocks like IndusInd Bank, which are neither too big nor too small, which gives you an opportunity when it corrects deeply. Last year in my Tamil channel, I asked you to buy IndusInd Bank when it was in the 400s and 500s because there was a rumor that this bank would sink. Initially, during COVID also, at one time, the price had dropped to that level. So there was two buying opportunities at extremely distressed valuation in IndusInd Bank. Even now, with sustained increases in interest rates, IndusInd Bank has corrected. It has corrected from 1275 to 1064. At 1064, it is almost trading 1.9 times its book value. The book value of a bank primarily represents the loan book of a bank. Today at the market, IndusInd Bank is selling nearly two times book. There is another small private sector bank which I have been tracking consistently called Federal Bank, which is primarily operating out of Kerala. The managing director of that, Mr. Srinivasan, is trying very hard to make this into the big league bank and therefore pushing very hard. This bank has grown its credit by 20% this year, primarily concentrating on retail gold loans. While the credits given by the bank have surged by 20%, the deposit rates have not kept up at pace. So the banks had to rely to high cost certificates of deposits and term deposits. This is because the proportion of CASA accounts has dropped. That is, the amount of money raised through current accounts and savings account has dropped by 5 percentage points. This means that analysts believe that the net interest margin of Federal Bank will shrink, thus its profitability will shrink, and the price of the stock corrected to 128. The book value of this bank is 91. So once this storm settles, there is no reason why this should not also trade at two times book. So 180 rupees is a price I am expecting in a couple of years, only based on logic applied to IndusInd Bank and another bank in the same class called as IDFC First Bank. Therefore, it's a good opportunity to pile on to Federal Bank at this point of time. One may choose to buy IDFC First or even IndusInd Bank. I am not a SEBI registered advisor. This was only to illustrate to you how the banking system is affected by the actions of the Reserve Bank. Before buying, I suggest you consult your SEBI registered investment advisor or a broker. Thank you for watching Paisa Bolta Hai or Money Talks. If you like this video, hit the like button of our video and press the subscribe button of our channel and turn on the bell notification. If you do not turn on the bell notification, you will not be notified every time we put out a video. Once again, I thank you for your support for Paisa Bolta Hai.